Hey everyone. It's been pretty hard to ignore just how crazy the stock market's been this year.
Yeah, it's been a wild ride for sure.
The S&P 500 up 27%. The Nasdaq's gone up like 34%. It's like, should we all just grab a confetti cannon and get in on the celebration? But
There's always a but, isn't there?
always, right. And this but comes courtesy of an article from the Motley Fool. They're kind of waving a little warning flag about a possible market downturn. So in our deep dive today, we're going to try to figure out what's fueling this insane market growth, but we're also going to take a closer look at this warning sign and see what history has to say about it.
Okay, sounds good. Got to enjoy the party, but maybe hold back on spiking the punch just yet.
Right, exactly. So the article kicks off by talking about all the excitement around a better economy and, well, obviously AI.
Of course, AI.
Like overnight, it feels like everyone's suddenly become an AI expert. Are you invested in AI?
I am, yeah.
Are you thinking about it? What's going on?
Well, yeah, it's the hot topic right now. And I think for good reason. When the economy is doing better, companies have more room to grow. And it's the growth stocks that really grab people's attention, especially in tech. Think about NVIDIA and Palantir. Those are some companies at the forefront of this whole AI explosion. And investors are just clamoring to get in on that action.
Yeah, it makes sense, all that.
Yeah.
But then the article throws this curveball. The S&P 500 Shiller CAPE E ratio, it's gone above 35 now. What is that? What does that even mean?
Okay, I'm going to try to break it down. The Shiller CAPE ratio. It stands for cyclically adjusted price to earnings. It's basically a way to measure how expensive stocks are compared to their long-term earnings.
Okay.
What makes it different, though, is that it looks at earnings over a 10-year period and adjusts for inflation. So it's like a more stable way to look at the big picture.
So it's kind of like a long-range check on valuations then. But why is 35? What makes that number so important?
Okay, so imagine you're buying a house. You wouldn't just look at the price tag, right?
Yeah, no.
You'd want to look at things like the location, the size, the condition of the house.
Right.
So the Shiller CAPE ratio, it's kind of like that condition report for the entire stock market.
Okay, I'm starting to see the picture now. But this article mentions this ratio, the Shiller CAPE thing. It's only been this high 3 times in the last 67 years.
It's true.
And they even include this chart that really highlights that. Is that a serious red flag? Should we be worried?
It's definitely something to pay attention to. Historically, when the Shiller CAPE ratio gets this high, the market tends to self-correct.
Yeah.
Meaning prices drop.
Oh.
It's like stretching a rubber band, right?
Yeah.
It can only go so far before it snaps back.
Okay, so not a guarantee a crash is coming, but definitely a warning sign.
Exactly. It's just a reminder that the market, it can't defy gravity forever.
Right. And what's interesting is we're seeing this high CAPE ratio, even though there are a lot of positive things happening in the economy.
Yeah.
It does suggest, though, that maybe those valuations are getting a little, I don't know, ahead of themselves, maybe?
It could be, yeah.
So help me understand. For someone like me, for you listening out there, if we're thinking about investing right now, what does all of this mean? What should we do?
Well, the main takeaway from the article is to really pay attention to how individual stocks are valued. Don't just get swept up in the overall market hype.
Oh, okay.
Even when the whole market seems expensive, you can still find good deals. Companies with strong fundamentals and prices that make sense.
So it's like finding those amazing vintage finds at a thrift store, even when everyone else is paying top dollar for brand new clothes.
You got it.
You just got to know where to look.
Exactly.
So the article gives some examples of this, right, in the AI sector.
It does.
What were they again?
Okay, so they highlight companies like Alphabet, which is trading at 24 times forward earnings, and Meta Platforms, which is at 27 times.
Wait, hold on. Forward earnings. What does that even mean?
Yeah, good catch. So forward earnings are basically predictions made by analysts about how much a company is going to earn next year. So when we say Alphabet is trading at 24 times forward earnings, it means investors are willing to pay $24 for every $1 of profit that Alphabet is expected to make next year.
Okay, that makes more sense now. So why are those numbers, 24 and 27, considered reasonable in this market right now?
Well, compared to that overall Shiller CAPE ratio we were talking about, 35, they're significantly lower.
Okay.
Plus, both Alphabet and Meta, they're still considered to be growth companies with a lot of potential.
Yeah.
So even those multiples might be justified.
So it's like finding a designer item on sale?
Yeah.
You're still getting that quality, but at a better price.
Exactly.
I like it.
This is important for our listener. It's easy to get swept up in the excitement, all the hype of a booming market, but it's always important to do your research. Really understand what you're buying and, look for value.
Excellent point. So we've established the market's hot, AI's adding fuel to that fire, but those high valuations, well, they could mean trouble's brewing.
Yeah.
What else does this article tell us? What else should we be thinking about?
Well, they talk a bit about interest rates, too. We've been in this low interest rate environment for a while, right? Which makes borrowing money cheaper. And that really can boost economic growth, make stocks more appealing.
Yeah, that makes sense. If companies can easily borrow money, they can invest more in growth, maybe see bigger profits, and that pushes stock prices up.
Exactly. But there's kind of flip side to this whole thing.
Uh-oh.
The article points out that interest rates have been going up lately. The Federal Reserve is trying to control inflation, and that's where things could get a bit tricky for the market.
Ah, okay, yeah, I see what you mean. So higher interest rates make borrowing more expensive, which could squeeze profits and make investors think twice.
You got it. It's like this push and pull between the excitement over growth and then this drag from rising rates.
Right, like a tug of war almost.
Yeah, a tug of war. And the article really emphasizes that investors got to be aware of both sides of that.
Right.
No denying the potential of AI, the positive stuff happening in the economy. But we also can't ignore those crazy high valuations and what rising interest rates might do.
So if we're trying to make sense of all this, what should the average person do? Should we be freaking out and selling everything we own?
No, not necessarily. Remember what we were talking about earlier, looking at individual companies.
Right.
Instead of getting caught up in the whole market frenzy, focus on companies that have solid fundamentals, strong earnings growth, a history of navigating those economic ups and downs.
So it's like building a house. You want to make sure that foundation is strong, no matter what your neighbors are doing with their fancy landscaping.
Exactly. Don't get swayed by the hype. Do your research. Invest in companies that you actually believe in for the long haul.
That's really good advice. But how does someone like me, or anyone listening, actually evaluate individual stocks? That seems pretty daunting.
It can be, yeah. But the article gives some helpful tips. They suggest looking at some key financial numbers.
Okay, like...
Well, one is the price-to-earnings ratio, or PE ratio.
Okay.
It basically tells you how much investors are willing to pay for every dollar of earnings a company makes. So if Company A has a PE of 20 and Company B has a PE of 30, it means investors are willing to pay more for each dollar of Company B's earnings.
Got it. So it's kind of like comparing how expensive different stocks are relative to what they're actually earning.
Exactly. Another important one is the debt-to-equity ratio.
Okay.
This measures how much debt a company has compared to its equity. A high debt-to-equity ratio can be a red flag. It means the company's relying heavily on borrowed money. Think of two friends, both making the same amount of money. One has tons of credit card debt, the other is debt-free.
Right.
Who's in a better financial position?
The one without all the debt, for sure.
Exactly.
Okay.
So a lower debt-to-equity ratio usually means a company's in a healthier spot financially.
Okay, makes sense. What else should we be looking at?
The article also mentions return on equity, or ROE. This tells you how well a company is using its shareholders' money to make profits.
So a higher ROE basically means they're doing a better job of turning those investments into actual profits.
You got it.
Okay, but it's not all just numbers, right? There's got to be some psychology involved, too.
Oh, absolutely. And the article talks about that, the fear of missing out, FOMO.
Yeah, FOMO is definitely a thing.
Especially when you see everyone on social media bragging about their stock market wins. It's easy to get caught up in the hype and feel like you have to jump on the bandwagon.
So how do we avoid getting pulled in by FOMO? How do we make smart decisions and not just act impulsively?
Well, having a clear investment plan and actually sticking to it can help. Think of it like a roadmap.
Okay.
It lays out where you want to go, like your financial goals and how you're going to get there, your investment strategy. When you've got a plan, you're less likely to get sidetracked by all the shiny stuff along the way.
I like that, the roadmap analogy. Having a plan keeps you focused on the destination, even when there are bumps in the road.
Exactly. And remember, investing is more like a marathon, not a sprint. It's about making steady progress over time, not trying to chase those quick wins.
Which reminds me of something else the article talked about, diversification.
Right.
It's like that saying, don't put all your eggs in one basket. But what does that actually look like when we're talking about investing?
So diversification basically means spreading your investments across different types of assets, different industries, different geographic regions. You're not putting all your money into just one stock or one sector.
So instead of betting everything on one horse, you're spreading your bets across several horses in the race.
Perfect analogy. If one horse stumbles, you still got others in the running. Same idea with investments. If one does poorly, The others can help cushion the blow. Diversification helps manage risk and can potentially smooth out those market ups and downs.
Makes sense. It's
Uh-huh.
about building a more resilient portfolio that can handle different market conditions.
Exactly. You wouldn't want a portfolio that keeps you up at night worrying, right?
Definitely not.
Yeah. You want one that aligns with your comfort level and helps you achieve your goals. Now, speaking of goals, I know lots of folks are hoping this market boom will help them retire early. But the article kind of hints that even though things are going well, it doesn't necessarily mean everyone's going to get rich.
That's interesting. So even if the market keeps climbing, there could still be challenges for individual investors.
Oh, absolutely. One of the biggest challenges investors face, even in a good market, is their own behavior.
How so?
Emotions can really mess with investment decisions and often lead to some expensive mistakes.
Well, we were just talking about FOMO, but what other emotions can get in the way?
Fear is a big one. When the market dips, it's natural to feel scared,
Yeah.
You just want to sell everything to avoid losing even more money. But that panic selling can actually lock in those losses and prevent you from benefiting when the market bounces back.
So it's like jumping out of a plane because you hit some turbulence.
Right.
You might miss out on a perfectly safe landing.
Exactly. And on the other hand, there's greed. When the market's soaring, it's tempting to get greedy and chase those big returns. But remember, what goes up, most come down. Greed can make you overconfident, and you might end up taking on more risk than you can handle.
It's all about finding that balance, right? Enjoying the ride, but not getting carried away.
That's it. Investing successfully requires a balance of optimism, realism, and discipline. You have to believe in the market's potential, but also acknowledge the risks and stick to your plan.
Having that long-term perspective is crucial.
Absolutely. Short-term market swings are going to happen. It's the long-term trends that matter most.
This reminds me of something else from the article, this idea that it's almost impossible to perfectly time the market, buy low, sell high, What do you think about that?
Tons of studies have shown that consistently timing the market is really, really difficult. Even for the pros, there are just too many variables. Even if you somehow manage to predict the very top of the market and sell, there's still the challenge of knowing when to get back in. You could miss out on big gains if you wait on the sidelines for too long.
So instead of trying to be some market timing genius, what's a more realistic approach for the everyday investor?
Well, one strategy that's often recommended is dollar cost averaging.
Okay, I've heard of that, but how does it work?
It's actually pretty simple. It involves investing a set amount of money at regular intervals, regardless of what the market's doing. So let's say you decide to put $500 into a specific stock every month. Some months when the price is high, you'll buy fewer shares. Other months when the price is lower, you'll buy more shares.
So over time, you're basically averaging out the price you paid for those shares.
Exactly. It takes the emotion out of it and helps you avoid that temptation to try and time the market perfectly.
And it seems like that would be particularly helpful in a volatile market, right?
Right. Exactly. Speaking of volatility, one thing that worries a lot of investors is the possibility of a market crash. Is there any way to predict those? Or are we all just flying blind?
Yeah. Is there a crystal ball we can look into?
I wish. Predicting a crash with 100% certainty is impossible.
Yeah.
There are just too many factors at play, and many of them are unpredictable.
So it's like trying to read tea leaves, right?
Yeah, kind of. But that doesn't mean we should ignore potential risks. Like we talked about earlier, there are certain signs that can suggest the market might be overvalued or headed for a correction.
Right, like those high valuations we were discussing, using that Shiller CAPE E ratio.
Exactly. And it's important to keep an eye on things like economic data, interest rates, and what's happening around the world geopolitically. By staying informed and being aware of potential risks, investors can make smarter decisions.
So it's not about living in fear of a crash, but about being prepared for the possibility of one, right?
Exactly.
Yeah.
And the best way to prepare is to have a diversified portfolio, a long-term investment mindset, and a clear understanding of your own risk tolerance.
So essentially, stick to those sound investing principles we've been talking about.
Precisely. Now, since we're talking about technology's impact on the markets, the article does mention artificial intelligence. AI, it's everywhere these days, and the stock market's no exception. How is AI changing the way people invest?
It seems like it's changing everything these days. What's happening in the world of investing?
Well, one of the biggest ways is through these robo-advisors.
Robo-advisors. I've heard that term before, but I'm not really sure what they are.
Think of them like automated investment platforms that use algorithms to manage your portfolio.
Okay.
You answer a few questions about your financial goals, how much risk you're comfortable with, and how long you plan to invest. And then the robo-advisor puts together a diversified portfolio for you.
So it's like having a personal financial advisor, but without the expensive fees.
Exactly. And they're getting more and more popular, especially with younger investors who are tech savvy and looking for a cheaper way to invest.
Yeah, that makes sense. What about AI being used for actual trading?
Oh, that's happening too. AI is being used to create these sophisticated trading algorithms that can analyze tons of data and execute trades super quickly. It's called high-frequency trading, and it's become a major force in the market.
Wow, it sounds super complex and really fast-paced.
It is.
Yeah.
It can actually increase how liquid the market is and make things more efficient, but it can also add to market volatility and make things a bit unfair for smaller investors.
Right, so it's like any powerful tool. It can be used for good or for, well, not so good purposes.
Exactly. Now, switching gears a bit, the article also touches on the importance of ethics in investing.
Oh, interesting.
Yeah, they suggest investors should think about the values of the companies they're putting money into.
Yeah, it seems like that's becoming more and more important to people. It's not just about profits anymore.
Right. People want their investments to align with their personal values. And that's where ESG investing comes in.
Okay, ESG investing. Can you break that down for us? What does that even mean?
ESG stands for Environmental, Social, and Governance. It's an investment approach that considers a company's impact on the environment, how socially responsible they are, and their corporate governance practices.
So it's about investing in companies that are not only making money, but also doing good things for the world.
Exactly. Investors are increasingly looking for companies committed to sustainability, ethical practices, diversity, and inclusion.
It's like voting with your dollars, right? Supporting the companies that are trying to make a positive difference.
Exactly. And the good news is there are lots of ways to include ESG factors into your investment strategy. There are mutual funds and ETFs that specifically track companies with strong ESG ratings, and you can even screen individual stocks based on their ESG performance.
So whether you're working with a financial advisor or managing your own investments, there are ways to make sure your portfolio aligns with your values.
Absolutely. And remember, investing in companies with good ESG practices isn't just about feeling good. It can also be good for your wallet.
Oh, interesting. How so?
Well, companies with strong ESG practices tend to be better managed, more innovative, and less risky. They're also more likely to attract and keep top talent and build strong relationships with their customers. All of these things can contribute to long-term financial success.
So it's a win-win. You're investing in companies that are making a positive impact and potentially boosting your returns at the same time.
Exactly. It's a powerful combination. This has been really insightful. We've covered so much today. Understanding what's driving the current market, exploring the potential risks, and even navigating the emotional side of investing. It's clear that investing is a lot more than just picking stocks and crossing your fingers.
It definitely is. It requires knowledge, discipline, and that long-term perspective you were talking about.
Couldn't agree more. And I hope our listeners are feeling more empowered to make informed decisions and reach their financial goals.
Me too. Now, before we wrap up, I want to go back to something you mentioned earlier. The importance of being patient when it comes to investing.
Oh, patience is crucial. Building wealth through investing is a marathon, not a sprint. It takes time, discipline, and a willingness to ride out those market ups and downs. We all know they're going to happen.
It's like planting a tree. You don't expect it to grow into a giant oak overnight. It takes time, care, and patience for it to reach its full potential.
Exactly. Your investments need time to grow, just like a tree.
So what advice would you give to investors who are feeling impatient? Tempted to make quick decisions based on what the market is doing right now.
Focus on your long-term goals and remember why you started investing in the first place. Don't get distracted by all the noise and hype. Stick to your plan, and don't be afraid to talk to a financial advisor if you need help staying on track.
That's great advice. It's so easy to get wrapped up in those daily market movements, but it's important to remember that this is a long game.
Exactly. Now, I know we've talked about a lot, but there's one more thing I wanted to bring up before we move on. The article mentions the possibility of a market correction happening in 2025. What are your thoughts on that?
It seems like every year there's talk of a possible correction or even a crash. How seriously should we be taking these predictions?
It's important to remember that no one can predict market movements with absolute certainty. There are just so many factors involved, and many of them are impossible to predict.
So like we were saying before, it's like trying to read tea leaves.
Yeah, exactly. But that doesn't mean we should just ignore the potential for risk. Like we've discussed, there are some indicators that can suggest the market might be overvalued or due for a correction.
Right, like those high valuations we were talking about with the Shiller CAPE ratio.
Exactly. It's also smart to pay attention to economic data, interest rates, and what's going on in the world politically. By staying informed and knowing about potential risks, investors can make more educated decisions.
So it's not about living in fear of a crash, but about being prepared for the possibility of one.
Right. The best way to prepare is to have a well-diversified portfolio, a long-term investment mindset, and a good understanding of your risk tolerance.
So basically, stick to those fundamental investing principles we've been talking about all along.
Exactly. Now, I know we're running out of time, but there's one last thing I want to touch on before we wrap up. The article really stresses the importance of choosing individual stocks carefully, even if the overall market seems a bit overpriced. What advice would you give to investors who are trying to find those hidden gems, the ones that are still undervalued?
Yeah, where should they even start?
The first step is to do your homework. Don't just rely on headlines or what people are saying on social media. Really dig into a company's financial statements, read what analysts are saying, and understand the industry they're in. Look for companies with strong earnings growth, a good track record, and a real competitive edge in their market.
So cut through the hype and focus on the fundamentals.
Exactly. And don't be afraid to think a little differently. Sometimes the best opportunities are in companies that aren't well known or followed by a lot of analysts.
It's like finding those hidden treasures at a flea market.
You got it. Now, always remember, investing has risks. There are no guarantees. But by being disciplined, doing your research, and staying informed, you can definitely improve your chances of reaching your financial goals.
This has been such an informative deep dive. Thank you so much for sharing your expertise with us today.
It's been a pleasure. I always enjoy talking about this stuff and helping people make smarter investment decisions.
Well, we've definitely given our listeners a lot to think about. And like always, we encourage everyone to keep learning about these topics, do their own research, and make choices that feel right for them. But before we wrap up completely, I have one final question for you, and for our listeners too. If you were going to invest in the market today, what would be the most important things you'd consider when choosing a stock?
That's a fantastic question, and it's one that everyone should think about carefully. For me, I'd look for companies that are really pushing the boundaries of innovation and are tackling some of the world's biggest challenges.
So companies that are not only profitable, but also doing good for society?
Exactly. I believe that investing in those kinds of companies is not only smart financially, but also ethically the right thing to do. It's about aligning your investments with your values and making the world a better place.
I love that approach. It's like investing in solutions for a better future.
Exactly. And I encourage our listeners to do the same. Think about what's important to you and look for companies that share your vision for the future.
That's a powerful message to end on. Investing isn't just about making money, it's about building the world we want to live in. Thank you for sharing that perspective.
It really is, isn't it? It's almost like we're not just building our own portfolios, but also helping to create solutions to some of these massive problems.
Yeah, it's kind of cool to think about it that way.
So just to kind of bring everything full circle, it feels like we're in this really interesting, maybe even a little risky spot right now. The market's been amazing. AI is driving so much innovation, but those high valuations, especially that Shiller CAPE ratio, it's making us think twice, right?
Yeah, for sure. It's almost like we're at this incredible party, but we're kind of keeping an eye on the exit just in case things get a little out of hand.
Huh. That's a perfect analogy. We're not saying run for the hills just yet.
Yeah.
It's more like enjoy the party. Be smart about it.
Right.
Choose your conversations wisely. Make sure you're talking to those companies with solid fundamentals. Don't get swept up in the hype.
Like being at a buffet with all your favorite foods. You want to enjoy it all, but you also got to be mindful of how much you're piling on your plate.
Exactly. Moderation and balance are key. And that's true whether we're talking about the stock market or, just making good choices at a party.
Love that. So as we wrap up this deep dive, what are some of the main things you want our listener to walk away with? What should they remember?
Well, first off, don't panic. The market goes up, it goes down. It's always been like that. The key is to think long term and not let those day-to-day or even month-to-month changes throw you off track.
Yeah, don't get distracted by those short-term market swings. Remember, investing is a marathon, not a sprint.
Absolutely. And that kind of leads into my second takeaway. Do your research. Don't just follow the crowd or put your money into something because your friend told you to. Take the time to really understand the companies you're investing in. Look at their financials. what their management team is like, what their long-term potential is.
It's like buying a car, right? You wouldn't just pick the first shiny one you see on the lot. You'd want to test drive it, check out the safety features, maybe even look under the hood.
Exactly. And finally, don't be afraid to ask for help if you need it. Talk to a financial advisor. Read some reliable financial publications. Just keep learning and growing as an investor.
Those are really great tips.
Yeah.
So to put it simply, stay calm, stay informed, stay focused on your long-term goals.
You got it. And remember, investing can be exciting, it can be rewarding, but it's a journey.
Well said. We've covered a ton of ground in this deep dive. From all the excitement around AI to that, kind of cautionary tale of the Shiller CAPE ratio. From the power of diversifying to why ethical investing is becoming so important. I hope everyone listening feels a little more knowledgeable, a little more confident about navigating the market and making smart decisions that align with their goals and values.
That's what we hope for, giving people the information and tools they need to make those good choices.
And on that note, we're going to wrap up this deep dive into the market. Thanks for joining us, everyone, and happy investing.